Today we will be looking at rental properties. Generally, when renting out a property, you declare the rental income received and you can also claim some expenses incurred for the time the property is rented or is genuinely available for rent. A property is genuinely available for rent where it is advertised and tenants are reasonably likely to rent the property. Rental and other rental-related income is the full amount of rent and associated payments that you receive, or become entitled to, when you rent out your property, whether it is paid to you or your agent. You must include your share of the full amount of rent you earn in your tax return. Your rental income also includes rent or associated payments that you receive, or become entitled to, when renting out part or all of your home through the sharing economy or the renting of your holiday home. There are three categories of rental expenses: those for which you cannot claim deductions, can claim an immediate deduction in the income year you incur the expense, or can claim deductions over a number of income years. You can claim a deduction for certain expenses that you, rather than the tenant, incurred and paid, such as expenses associated with finding tenants including advertising, property agent fees or commissions and lease document expenses. Administrative expenses including printing, stationery, telephone calls and postage. Fees, charges and taxes including bank charges, council rates, land tax, interest on loan. Maintenance and upkeep expenses including gardening, lawn mowing, cleaning, pest control, repairs and maintenance or servicing costs. Borrowing expenses including brokerage fees, stamp duty and loan establishment fees. Please note that borrowing expenses exceeding $100 must be deducted over the loan period or 5 years, whichever is lower. Utilities including electricity, gas and water. In limited circumstances, you can also claim a deduction for depreciation equal to the decline in value of a depreciating asset, for example stove, fridge, used in the rental property over the income year. Capital works including the building itself, an extension or alteration, for example adding a room, removing internal walls, and structural improvements, for example adding a gazebo, carport or fence. Capital works deductions are usually claimed over either 25 or 40 years. You cannot claim a deduction for any expenses the tenant has paid. The costs of traveling to visit your rental property for inspections or maintenance. The cost to purchase the property or any fees associated with its purchase. The costs associated with selling the property. The expenses related to the private use of the property. These must be apportioned, for example using your holiday house both for private use and rental use. You can refer to the Australian Taxation Office Guide on Rental Properties to see a full list of rental property expense. Rental expenses are deductible to the extent that they are incurred for the purpose of producing rental income. In some instances, you may need to apportion the expenses where the property was privately used, or only genuinely available to rent, for part of the year. Only part of the property is used to earn rent. The property is rented at non-commercial rates. Your investment loan is partially used for private purposes. A rental property is negatively geared if it is purchased with the assistance of borrowed funds and the net rental income, after deducting other expenses, is less than the interest on the borrowings. The overall taxation result of a negatively geared property is that a net rental loss arises. In this case, you may be able to claim a deduction for the full amount of rental expenses against your rental and other income, such as salary, wages or business income, when you complete your tax return for the relevant income year. Where the other income is not sufficient to absorb the loss, it is carried forward to the next tax year. You must keep written records that are in English, or readily translated to English, for any income and expenses associated with renting out your property. The record should be kept for at least 5 years from the later of either your income tax return lodgement date or 31st of October of the relevant financial year that the expense was incurred. The written record should include details concerning the name of the supplier and their Australian business number, amount of the expense, nature of the goods or services and date the expense was incurred as well as the date of the document. It is important to note that the property may be subject to capital gain tax upon sale. Accordingly, you should keep documents relating to the property's initial purchase, and any capital improvements made during the period of ownership. You should also consider the need to obtain advice regarding any CGT discounts or exemptions you might be entitled to when the property is sold. Foreign rental property. If your property is located outside Australia, special rules apply to the deductibility of your rental property expenses, so you will need to refer to the rules on foreign income. If you need any further assistance on understanding your tax responsibilities and owning a rental property, please contact the Australian Tax Clinics or the Australian Taxation Office. Thank you for watching our video.